So let's get in our guest who is joining us now on the show, Chintan Kothari. Chintan, good afternoon. Thank you very much for your time. The focus right now, because of the news flow, is on chemicals and pharma stocks. Not only because in the market they're doing very well, but because there's a lot of institutional action which is happening out there. A lot of PE deals are happening. We saw the recent one, the Radiant, the JB Chem and KKR deal. You've done similar deals, not only this, many in the past. Piramal's in their pharma business also concluded a recent deal. In the last couple of months, there's renewed action out there. If we were to take a step back and not only chemical and pharma, but the entire healthcare pack, not from the stock market angle, but from the really long-term capital orientation, be it pharma, be it chemicals, EPIs, hospitals, diagnostics, how are you analyzing this entire space? Because you work in the thick of things.
Thanks, Ajay. Look, first of all, thanks for having me on the channel. Really appreciate it. And before I start, I would like to just say a word of thanks to the entire healthcare ecosystem, all the companies, the promoters, the employees, the workers that are managing supply chain, factories, the frontline healthcare workers amidst this difficult environment. So a big thanks to everyone associated with the healthcare ecosystem. I think when you talk about healthcare, I would like to break this into really three parts, right? One is pharmaceuticals, healthcare delivery, and then we have medical equipment and devices and medtech. The macros that support the pharmaceuticals industry across domestic formulations, the exports-oriented businesses, APIs, contract manufacturing businesses, as well as the large generic businesses that have multi-geography businesses continue to remain quite strong. The Indian market continues to grow at about 10%. It's down from its heydays of about 14-15%, but provides a beautiful linear growth of 10% to businesses on a consistent basis. Large brands, businesses with deep therapeutic focus are doing very well. The API CDMO businesses are doing very well, driven by macro issues around China. Due to the environmental policies that China has implemented, a number of businesses in China have been shut down. That has created supply chain disruption. On top of that, you've had compliance management issues that have hampered these businesses in China, and China's own desire to continue to move up the value chain, right? So that presents a fantastic opportunity for Indian businesses, API, CDMO players, CMO businesses. And lastly, the large cap and the mid-sized generic businesses with regulated markets, emerging markets focus. Those markets are starting to stabilize. The US market has stabilized quite well in the last few months. When you aggregate all of this, clearly that is driving very good investor interest. Investors are able to underwrite businesses, business plans with a reasonable degree of confidence. And that is clearly, driving the heightened M&A activity, heightened growth capital investments from private equity. What also is happening within the pharmaceutical ecosystem is there is a generational change happening. A number of family businesses see this as a great opportunity to partner with capital providers and drive institutionalized businesses, enhance businesses, invest for the long term. And clearly that is, becoming a big theme as we look at private equity's interest in Indian pharma, right? I think coming back to healthcare, first of all, I would just like to say that the healthcare industry in India is relatively newer compared to pharmaceuticals. It is a 20-year-old industry, 25-year-old industry, especially private organized healthcare. And external capital, especially private equity and growth capital, has played a very important role in building out this industry. while the activity in healthcare has come down a little bit in the last year to 2 years due to various factors, and we can touch upon that. We do believe that the scale of the industry and the under-penetration clearly lends into creating large outcomes in healthcare. And we do believe that investor interest will remain high even in healthcare. And when you look at the ownership patterns in pharma versus healthcare, one big distinction that you see is that when you look at the top 50, 75 pharma companies, the level of external ownership, i.e. private equity, private financing ownership compared to healthcare is significantly low. In healthcare, a lot of businesses, most large, mid-sized, small businesses have private equity ownership because of the financing nature of the business. And that clearly will drive heightened deal-making activity over the next few years in healthcare.
Right. Chintan, let's break up these different businesses into buckets, because these are completely different businesses. Ownership patterns are different. The environment which is playing on each of these kind of businesses is very different, and of course the return profile. You interact with clutch of these investors who may be looking at these various buckets in different ways. What is the order of priority in terms of attractiveness, where you see deal flow higher, and also how what kind of promoter ownership patterns is likely to play as a factor whether deals happen or not? Because say pharma, big pharma is well capitalized, promoter owned companies, there is no real big trigger to partner with private equity, whereas mid cap pharma may need private equity help for scale up, big R&D and capex. Chemicals, another area of high interest where PEs may be interested, but there are very few high quality companies out there. So how do these combinations are actually playing out from the investor's point of view?
Within pharmaceuticals, I would like to break it down into 3 or 4 key buckets, right? I think the first one is our own market, home market, the domestic formulations market. It's a large industry and still remains highly fragmented when you compare the nature of Indian domestic formulations market compared to US or other large emerging markets. The top 10, 15 players own about 50% market share. We believe that is likely to change over the next 5-7 years. Consolidation activity has historically been slow. The last year has seen what I would say has seen an inflection point in domestic formulations consolidation. And we do believe that over the next 5-7 years, the ownership profile of a lot of family-owned businesses will change in domestic formulations. I think what has also happened is the last 10-15 years have seen an emergence of a new set of domestic formulations companies, focused on aggressive growth, aggressive investments. And in those changing times, it's very, very important for some of the older businesses to sharpen up, and partnering with external investors is a great way of doing it. It need not be a controlled transaction. It could be a win-win partnership, a 50-50 partnership. It could be growth capital for further investments. So domestic formulations will see a different type of activity. When you come to our traditional large cap, mid cap generic businesses, we do believe that the activity will center around capability building, technology additions, and that will be largely outbound in nature. Most of these businesses have large India-centric businesses, and they will continue to invest in India and grow India. But the real investment in terms of capability, technology will happen largely outside of India, and specifically in regulated markets, US being the primary market for most of these businesses. I also believe that the next 2-3 years, unlike in the last 5 or 10 years, if you would have seen, there has been very, very little capital raise that has happened by the larger to mid-sized players. These are good businesses, strong balance sheets, but that is likely to go through a change. We do believe that a number of businesses will raise capital ahead of their need and will capitalize themselves strongly to continue to build these businesses. The investment cycle in pharma is not a 2-3 year cycle, it's a 5, 7, 10 year cycle. And hence, it's very, very important for the large to mid-sized businesses to raise capital ahead of time and really invest for the long term, right? When you see the level of capital raise that has happened in India in the last 10 to 15 years, compare it to what you see in China, we've literally, in pharmaceuticals, we've raised probably about $1.5 billion to $2 billion at best. China is at 20x just in the last 4 to 5 years. So the entire ecosystem needs to kind of get energized. We need to build deep capabilities within India, more investing, more high risk investing, and hence businesses will, be tempted to raise capital and will be keen to raise capital ahead of time. I think then there is a set of businesses, API, CDMO businesses that are centered around the export markets. I think the overall disruption in global supply chain, some of the macro issues are actually, clearly favoring these businesses. There is strong investor interest, and these businesses will continue to invest in capacity. We've already heard enough of the API disruption and the need for self-reliance. I think that plus the ability to kind of build, and really India has historically been very, very strong at chemistry, use manufacturing, product development capabilities for export markets. We do believe that API and CDMO businesses will come back and do that at scale than what you've seen in the recent past.
5 minutes. Chintan, let's talk about the size of the deals in various buckets. Hospital and diagnostics as a space itself is a smaller mid-cap kind of space. Chemical and specialty chemical even smaller. What kind of money are you likely to see coming in the broader segment of all these buckets? Some color on what kind of deals may happen, what kind of inquiries are happening in the industry, if you could share with us.
Just to give you some data points, in the last 3 years, we've seen about $10 billion worth of activity, within the healthcare ecosystem, about a 70-30 mix between pharmaceuticals and healthcare. 2/3 of that activity has been driven by private investors. So clearly, the scale of the activity has picked up compared to what it was a few years back. When I use that number of 10 billion, that excludes any outbound activity that has happened. So that has been kind of one big change, especially in pharmaceuticals, where a lot of the activity has been domestic centered, right? Healthcare, when you look at, as I kind of go back to the point I made earlier, when I look at the next 2 to 3 years, I expect over $5 billion of activity to take place within the healthcare ecosystem. And those are conservative numbers from my standpoint. A lot of healthcare delivery businesses, hospitals, diagnostic chains, daycare businesses, eye care, oncology, nephrology, has seen strong private investor interest. You will see exits happen in the next 2 to 3 years. That will drive a large part of deal-making activity within the healthcare delivery universe. Pharmaceuticals will continue to see a lot of activity there. And I think there is a new space, right? Health tech. And you've seen the impact technology can make during these COVID times. And there is going to be strong investor interest even within the health tech space, where you're seeing, capital build out some very, very interesting partnership with exciting entrepreneurs, build out some very, very interesting businesses, which will allow technology in combination with deep clinical protocols, skill sets to deliver healthcare to rural markets and at scale, right? I think the challenge in healthcare delivery always has been, how do you take quality and deliver it in tier 2 markets, tier 3 markets, rural areas. And the only way that gap can be bridged is through technology. And we'll see some interesting businesses. We will also see the larger businesses in healthcare invest deeply in technology to enhance their offerings, because they want to be capital efficient. You cannot go out and create physical infrastructure in every city, in every tier 2 city, in every rural market, right? The other challenge is there is a deep shortage of talent, medical talent in healthcare. And all of that can only be bridged through technology.
Right. No, clearly that is a very valid point, Chintan. In